What does GDP actually mean? Are European value-added taxes tariffs on America? And does the US need a sovereign wealth fund? I'm Dominic Pino, Thomas L. Rhodes Journalism Fellow with the National Review Institute, and we'll look through those questions on this episode of Econception. Econception is a podcast of the American Institute for Economic Research that looks at the economic issues of the day and the broader economic concepts behind them. We're recording today on location from the US GDP, which is everywhere and nowhere. I wanted to talk about GDP today. We don't have a guest for you because this is something that's been on my mind for a while and comes up basically once a quarter whenever the Bureau of Economic Analysis releases the GDP data. There's lots of misunderstandings about what GDP actually is and what it's used for. So I wanted to sort of walk through what's really going on. Because you'll hear a lot of times people will talk about GDP as just the number that the Bureau of Economic Analysis releases. And they'll look at the equation that they use and try to argue that you can manipulate the GDP by changing parts of that equation. And this is really the wrong way to think about it. That number that the Bureau puts out right now for the United States, it's in the neighborhood of $26 trillion. It's the United States GDP, roughly. And that's just a huge number. It's just a massive number. It's really hard to put into perspective what that actually means. And it might be hard to see why that's relevant at all. And really, that number itself is not really relevant. It doesn't matter very much. But what GDP is supposed to be the total economic production of a country in a given period of time. So usually it's in a year. And usually it's in the borders of the United States. So let's break down what GDP means. It stands for Gross Domestic Product. Gross, in this case, doesn't mean icky. It means everything. It means the entire domestic product. Domestic, of course, means here in the United States. And product means output, economic output. There's another statistic called gross national income. That's the same idea, except it's the income instead of the output. In theory, those two numbers should be the same because every time you pay someone for something, you're paying for their output. So really, those numbers should be equivalent. But GDP is the gross domestic product. Now, why would we want to know what the gross domestic product of a country is? It's really not so we can just get that number. It's really so that we can track how that number changes over time. It doesn't particularly matter what the number is, it matters how it changes. If it's going up, that means we're producing more stuff. Producing more stuff is good for an economy. We don't want to be in a situation where year over year we're making less. That's a recession. And so that's the point of GDP. But GDP is a measurement of all of the stuff, all of the economic activity that's going on inside of a country. And that economic activity is not a number. That economic activity is people doing stuff, making stuff, selling it. It's people coming up with really good ideas and marketing them and making money. It's every time you go to the grocery store. It's every time you go to the gas station. It's every time you go to work. That is what GDP is measuring. All of that stuff added up over the whole country. And it gets boiled down and condensed. All of that completely disaggregated information gets boiled down and condensed into one number. And we call that the GDP. Now, obviously, anytime you're taking that much stuff and putting it into one number, it's a big oversimplification. It's a huge oversimplification. There's lots of stuff that GDP doesn't count. There's lots of stuff that GDP ignores. But for what we're trying to do it's still a useful tool. It's by no means the only useful tool. There's all sorts of other economic measurements too. But it is the one tool that tries to take all the economic activity and compress it down into one thing. So then we can compare it year to year and we can see how we're doing. So that's the value of GDP. Now you can see how this is a really useful idea. It helps to guide government policy. If the economy is growing, the government should behave differently than if the economy is shrinking. Those are two very different situations for government policymakers. So it helps them to know which one is which. We used to not have very reliable information about this. Now we do. So that's a good thing. So that helps. It's also useful just for economic research. You can look at historical data on this and have an idea of what the economy was like in 1900. You can tell how much it was growing then. You have these historically constructed data sets that allow you to study that. That's very useful too. Again, the actual GDP number was way smaller then, but you can still do the percent growth year over year and get a reasonable comparison. Think about how you would possibly do that without having a statistic like GDP. The people in 1900 that were buying and selling stuff were buying and selling totally different stuff than we do today. They were doing it in totally different ways. They had totally different ideas. But GDP is the constant statistics that allows us to go back and compare that to today. Because in both of those economies, we can still try to add up the value of all the production. Even though the production is it's of totally different stuff done by totally different people. And we can do the same thing by comparing between countries. Now, this is a little bit trickier because you have to adjust for inflation and purchasing power and things like that. But we have ways to do that too. And it can help us to compare that way. So again, this is a very valuable statistic, even though it is a huge oversimplification. So once you come up with the idea of calculating GDP, you have to figure out how you actually do that. Because, like I said, it's a number that refers to a bunch of stuff that's not a number. It refers to economic production. It refers to cars and bagels and gasoline and chemicals and doctor's offices. It's a crazy concept to try to calculate. So how do we actually go about doing that? You can't just go out and observe the GDP. You have to figure out how to make a mathematical way to calculate it. And so that's what economists have done. They take an equation that basically boils down to 5 different parts. It's consumption, investment, government spending, exports, and imports. So let's go through each of those 5 components of the GDP. So, consumption is the first one. We don't have a lot of really good ways to go calculate production, but we do have better ways to calculate consumption. Consumer spending was something that economists were tracking around the time that the idea of GDP became standardized. Consumption economics, this is something that was a very important economic field in the 1920s, 1930s, 1940s. It's actually how Milton Friedman got his start as an economist, was in consumption economics. It was also a very popular field for female economists at the time, which was unusual because most economists at that time were men. So economists had already started to create pretty sophisticated ways of tracking consumption in an economy. And you can do that a variety of different ways. There's a ton of different private industry groups that collect data on this for their own industry. So you can take those and add them together. There's also ways that you go out and survey households, you survey businesses, you see what kind of spending is happening on consumption. So that's a really good spot to start if you want to calculate the GDP, right? Because at least in the United States, we now know, about 75% of our GDP is from consumption spending. And so that's a really good spot to begin because you're guaranteed that the consumption is happening in the United States, right? Because all the people you're asking the information from are in the United States. That's where they live. So it helps to knock out that domestic part. It gets pretty close to that gross part because, like I said, you're covering a big chunk of the spending. And all that spending is on production. It's on something that people have made. The problem with it is that you don't know if the spending is being done on goods that were produced in the United States. You could ask a household how much they spent on consumption, but you don't know how much of it they spent on domestic consumption. And remember, the point of this statistic of GDP is to get the domestic product, not the total consumer spend. So that creates a problem. We'll come back to that one later. So keep that in mind. We're going to move on to the next component now, which is investment. Now, you want to include investment in GDP because not everything that happens in an economy is just on buying stuff. We also buy assets. And so you want to include investment in there too. This is also a reflection of people's savings. Savings get invested. They either get invested by you personally, because you save your money and you buy stocks or you buy bonds, or they get invested by the bank because you put your savings in a savings account at the bank and then the bank goes out and invests it in other stuff. That's an important component of economic activity that we want to track, that we want to know about, and that we want to include in GDP. And so investment gets included. Investment is not a very big component compared to consumption in the United States. It's only a little bit, but it's important to have in there. The next one is government spending. In most countries, the government is the largest single customer of stuff. Government buys a ton of stuff. It does that in a lot of different ways. You can think of government buying stuff for the military. You can think of the government buying stuff for healthcare. You can think of the government buying stuff for education. But just think of all the things that the government does. They have to go buy a bunch of stuff from the private sector in order to do that. The government mostly doesn't make its own stuff. It has to go buy it from other people. And so this is another really obvious place to go because it condenses a lot of different information about production into one place, the government budget. So again, if you want to know how much the government is buying or how much total economic activity is happening in a country, a decent place to look to knock out a big chunk of it is usually the government's budget. So that's why this is included in here. Because we already had, in the 1930s when this statistic was being developed, we already had really good data on government spending. And this is true in countries around the world. Even poor countries, even small countries, usually have pretty good information on how much their government is spending because they have to keep track of that stuff. And most of the stuff the government buys, it's buying from Americans. So it's a good spot to look for domestic production. So let me get to those last two chunks, which are exports and imports. These two components are the international components, right? An export is something you send to another country, and import is something you buy from another country. And that's where we adjust for the problem I mentioned earlier, which is that for consumers, if you ask consumers how much they're spending, you don't know how much is being spent on domestic versus international goods. You know how much they spent in total, and that's good. But in order to adjust for that, to get the gross domestic product, you have to subtract the imports. Now, there's also a part of consumption spending on American-made stuff that doesn't get counted in GDP because the consumption is done by people in other countries. So that's why you have to add the exports. This is another case of where the data is just very easy to get. Basically, all countries around the world keep very detailed records of goods that come into and leave their country because they have a customs agent on the border who writes down this stuff as it happens. And so import and export data is usually pretty reliable, and it's usually pretty accessible for every country around the world. And so for the US, we have that data, it's sitting there. So in order to get the domestic product, you have to subtract the imports and add exports. And it's because the imports were counted in the consumer spending component of the equation, right? They were counted there, but they don't count for what we're trying to calculate, which is domestic production. That stuff was produced somewhere else. So in order to correct for that, we have to subtract it out. For exports, the stuff was produced here, but it wasn't counted in the consumer spending because the consumer spending part is only for Americans. So rather than go out to all the rest of the countries in the world and ask them how much stuff did you buy from Americans, we just add on the exports from the United States, from the data we already have. Saves time. It's easier. And it gets you to the exact same spot mathematically. So that's why imports are subtracted from GDP and exports are added to GDP. It's not because exports are inherently better than imports. And it's not because imports reduce the GDP. They don't. They have basically no effect on GDP. Mechanically, in the equation, because it has a minus sign, it often gets reported in the press that GDP was lowered because of imports. This is wrong. The only reason that has a minus sign is because of the data we have available, which is data on consumer spending and data on imports, and we're trying to calculate something for the United States. It's a similar story with government spending. People will look at the government spending component and say, oh, well, that has a positive sign. So if we spend more, we'll have more economic growth. We'll have more GDP if we spend more. And that might work for a year or two, but you create a problem. Remember, the government is the largest customer. If you make the government an even larger customer, you're not making more stuff. The government doesn't produce very much. And so if the government is an even larger customer, that means that stuff that was being bought by other people is now being bought by the government. You didn't make any more stuff. You didn't increase production. You just changed who's buying it. That doesn't increase GDP. It certainly doesn't do it in the long run. Now, a little extra government money in 1 year, that might do a little something. But in the long haul, it won't. And the other reason is that the government only gets that money to spend by taking it from other people, either through taxation or through borrowing. Borrowing is really just taxation in the future, because the money you borrow now, you have to pay back in the future. And even the borrowing part, when the government borrows more, that leaves less money to borrow for private individuals. So that's going to hurt the investment component. That's called the government's crowding out effect. So it's not true that just increasing government spending will increase GDP. The reason that we know this stuff is true about government spending and about imports, and these are the two components that people get most mixed up about in GDP. They'll say we need more government spending to increase GDP, or that imports reduce GDP. If these two things were true, we would expect there to be a correlation between government spending and GDP growth, and between low levels of imports and higher GDP growth. And we can look at this around the world. We can compare countries. And what you find is basically that there's no correlation at all. The way you do this for government spending is not by looking at the total amount of government spending, because obviously big countries are going to spend more dollars than small countries. So that doesn't help very much. What you look at is the government spending as a proportion of the GDP. You get a percentage. That way, you sort of equalize big countries and small countries, and you can make comparisons based on the percentages. And if you want to do that, there's basically no correlation. Some countries that spend a lot have higher economic growth. Some countries that don't spend very much have lower economic growth. But the opposite is true too. And so there's really no correlation. It's the same story with imports. If it was true that imports were bad for GDP, we would expect countries that import a lot of stuff to have lower GDP growth. Again, there's no correlation either way. Some countries with lots of imports have lower GDP growth, and some countries with lots of imports have higher GDP growth. And this makes perfect sense if you go back to the start, which is, what is the GDP? Is the GDP that equation? Is the GDP a math problem? Consumption plus investment plus government plus exports minus imports? Or is the GDP all of the stuff people do every day? When you understand that it's all the stuff people are doing, and that equation exists just so we can approximately measure it, then it's much easier to understand. Because you know that somehow changing government spending or rejiggering the trade balance doesn't make anybody more or less productive. It doesn't really change the way you do your job. It doesn't really change the way you buy your groceries. It doesn't really change the way you drive your car. It doesn't really change any of that stuff. Thomas Sowell likes to talk about how people need to think of real life and not think in words. This is a great example of that. That equation, consumption, investment, government, exports, imports, those are words. Then we attach numbers to them and we put them in a math problem and we get a number that we call the GDP. But that's not real life. That's a measurement of real life. And you can't change real life by changing the measurement. This is like saying you can change the temperature of a room by just putting more mercury in the thermometer. It doesn't change the temperature of the room. That just makes the thermometer wrong. It's a similar story with trying to manipulate the components of GDP to try to get more GDP. There are all these counterbalancing effects in the real world if you try to just focus on one of those categories. And so you got to be careful about how this stuff happens. And you got to not pay attention to the media and to politicians who try to tell you otherwise, because some of them have agendas in what they're doing and other ones just don't understand what they're talking about. So remember, the GDP is not the equation. The GDP is the real stuff that people do every day. So the talk of the town right now is about tariffs and about reciprocal tariffs. Now, because all of this stuff changes so quickly, you should know that I'm recording this on Friday, February 14th. And so if something comes out in the next couple days that changes exactly what the reciprocal tariffs are, I don't have any control over that. It wouldn't surprise me if they do something over the weekend, because they did this last time over the weekend, because the stock markets are closed over the weekend. So it prevents any big sell-offs over this rather silly and poorly designed policy. Again, it's not really a sign of confidence that you want to be announcing your policy when the markets are closed, but that's what they seem to be doing. Anyway, one thing that we do know has been talked about is value-added taxes in Europe acting as a trade barrier for the United States. This is something that the White House has said is a problem. They've said that the value-added taxes from Europe, they're called VATs, V-A-T, value-added tax. They say that these taxes act as tariffs on the United States, and so the United States needs to do tariffs on Europe to make up for it. That's a thing that we know for sure that they're talking about, so I want to go into depth a little bit more on that, because it's one of these things that facially, at first glance, it seems to make some sense. Because how a value-added tax works is that the value-added tax gets rebated for exports, and it still gets charged for imports. So it seems like it's giving exporters an advantage. Right? If they get the tax rebated for exporting it, but other countries, goods from other countries, still get charged with the tax when they come in, that seems unfair. And it is unfair if that was the only thing that's going on, but it doesn't consider the whole picture of how the tax works. So I want to get into a little bit more of that. This is a classic example of people using partial accounting. If you use partial accounting, it's exactly the same thing we were talking about in the first segment with GDP, actually. People are using partial accounting. They're not giving you the whole story. That's just by definition the case. And that's what's going on here with the value-added taxes. So, first of all, what is a value-added tax? We don't have that in the United States, but it's very common in Europe. Basically, every European country has one. A value-added tax is a consumption tax. So it's kind of like our sales taxes, except that instead of it being charged on the total value of a good, it's charged on the value that is added at each stage of production. So when a company gets raw materials and turns them into an intermediate good, they pay a value-added tax. They pay a percentage rate on the value that was added by that process. Then when they take the intermediate goods and they turn them into a final good, they pay a value-added tax on that process. But only on the component that was value-added. So they don't pay for the part that was on the raw materials, because that already got paid for. They only pay on the part they add from the intermediate good to the final good. And then when the final good gets to the consumer pays on the value added from retailing that product. So they don't pay on the other stuff because that's already been paid. Now, obviously, there's a decent amount of pass-through that goes on. So the business will pass that through to the final consumer. The chunk of the tax that they already paid will get passed on to the final consumer. And that's fine, because the whole point of the value-added tax is to be a tax on consumption. That's what it's for. It's an indirect tax, is what it's classified as. Direct taxes are things like income taxes. But the VAT is an indirect tax. Now, the whole point of a consumption tax is to tax all the consumption that happens inside of a country. So again, it's very related to what we were talking about with GDP, how you have to subtract imports and add exports. If Switzerland has a VAT, the point of the VAT, from Switzerland's government's point of view, is to tax the consumption of Swiss people. It's not to tax the consumption of everyone on the planet. That wouldn't be fair. They don't have the power to do that. And it's not the point. They control the tax policy for their country. So because of the way that the value-added tax works, because they collect the tax in portions throughout the production process, there's no way of knowing, until someone actually buys the final product, whether the tax is being paid on consumption in Switzerland or consumption somewhere else. So that's why when goods are exported, companies get rebated the portions of the VAT that they already paid. Because that consumption is happening somewhere else. It's not happening in that country. And there's no way to know until it actually gets exported. It's the same thing in the other direction. When a good is imported to Switzerland, that consumption is still being done by a Swiss person. So they should pay the value-added tax on it. So that's why when goods are imported to Switzerland, they still pay the VAT. That's the whole point. It's a tax on all consumption in Switzerland. That includes imports. The rebate deal goes both ways. A Swiss company that exports gets rebated the portion of the VAT they already paid. If an American goes to Switzerland and buys a whole bunch of stuff, they can also get the VAT rebated to them because they're not Swiss. Now, obviously, that happens more in one direction than the other in real life because it's very rare for someone to go to another country and buy enough stuff for the rebate to really make a difference. Whereas, a giant company in a country that exports stuff, they might get rebates of significant amounts of money. But the principle holds both ways. The point of the VAT is to tax consumption in the country that's levying it. Because these European countries levy it, they rebate for exports and they tax imports. Now, does that give goods in the country, so again, let's say Switzerland again, does that give Swiss goods an advantage over American goods in Switzerland? If you're a Swiss person and you want to buy a Swiss good or an American good, does the VAT advantage the Swiss good? No, it doesn't. Because you pay the same VAT either way. Again, the VAT applies equally to imports as it does to goods that are produced in the country. So there's no advantage there. Now, for the export question, it seems a little bit trickier. It seems like there is an advantage. Because the Swiss company exporting gets that rebate, and an American company exporting to that country, they still get charged the VAT. But again, we know from the consumer's point of view, it's no different either way. There might be other reasons that they prefer Swiss goods to American goods or vice versa, but it's not because of the VAT. But going in the export direction, it seems like a bigger deal. But think about it this way. Think about it in the concept of a sales tax in the US, because we're more familiar with those. If Hershey's in Pennsylvania had to pay sales tax on the chocolate that it sells in Ohio, if they had to pay Pennsylvania sales tax for chocolate that is sold in Ohio because it was made in Pennsylvania, that wouldn't be fair to Hershey's. Because the whole point of a sales tax is supposed to be a tax on consumption, not on production. And the consumption happened in Ohio. Ohio has its own sales tax. It doesn't matter that the stuff was made in Pennsylvania. It matters that it was consumed in Ohio. So if Pennsylvania's government was charging sales tax on Hershey's for the stuff it sold outside of Pennsylvania, that would be very unfair. It's exactly the same thing that's happening with the rebate for the VAT. The difference is that because the VAT is collected throughout the production process, these companies have already paid some VAT on goods that were sold in other places. A sales tax shouldn't do that because the sales tax should only apply to the final customer. So for a sales tax, it's very easy to get around this problem because you just don't charge businesses the sales tax. You only charge the final customer. With the VAT, it's more complicated and you have to have this rebate system. But all it's doing is getting you back to the same place you started. It doesn't give you any advantage. And that's why, this issue has been brought up for many, many years. Value-added taxes have been around for 50 plus years, and the U.S. has never had one. And so the U.S. has brought this up before, and they said, hey, this is an unfair subsidy. And over again, it has consistently been ruled, no, it's not. All you're doing is getting back to even. And so under trade rules, which have, prohibitions and rules against export subsidies, VATs are not considered to be part of that. So again, it's obvious from the consumer's point of view that it doesn't give any advantage. From the exporter's point of view, it's a little bit trickier, but still, all you're doing with the VAT rebate is getting back to where you started. You're not giving any advantage. And it's only because of the accident of when this tax is collected. So the U.S. should not be too bent out of shape about the value-added tax because it doesn't actually do what people are saying it does. And it's certainly not a reason to start a global trade war, which seems to be what the White House is intent on doing. Now, there's another idea that comes from other countries that the White House has said it's interested in copying, and this is actually a continuation from the previous administration as well. The Biden administration and the Trump administration have both talked about creating a sovereign wealth fund for the United States. So, the idea of a sovereign wealth fund is that you have a giant pot of money that's run by the government that is then invested to try to make money for the country. Now, there are some things that sort of act this way in the United States already, namely state pension systems. State pension systems are in many cases really, really large investors because they have all this money that they need to grow in order to pay their retirees. But a true sovereign wealth fund is based on the assumption that a country has a big budget surplus. They've got a bunch of extra money to use. And so it's very common to have sovereign wealth funds in petrostates, in countries that produce a ton of oil and don't really do a whole lot else. Because oil is very valuable, so they can make a lot of money off of it. And it's a lot of times it's more money than they could possibly spend in their government budget. So they create a sovereign wealth fund with the excess money and then try to invest it and grow it that way. Now, among sort of nice countries, Norway is the sort of go-to example for a sovereign wealth fund. They have one of the world's largest ones. It's worth over $1 trillion. Most of the other examples, though, are not so nice countries, places like Saudi Arabia, the United Arab Emirates, or China. But let's think about Norway. Let's just look at the comparison here with Norway and the United States. Norway has a savings rate of 8%, which is pretty high. They have a fairly stable debt to GDP ratio at about 44%. So that means their government debt is less than half of their total economic output. And it's pretty stable there. It's been around that spot in the 40s percentage-wise. It's been around that spot for a couple decades. So they have pretty stable government debt that is much smaller than their total economic output. And Norway runs a budget surplus almost every year. They've averaged a budget surplus of 10% of their GDP since the 1990s. So almost every year they've got extra money in their budget with nothing to do with it. That's a reasonable case for a sovereign wealth fund. What else are they going to do with the money? They probably don't want to go spend it in their economy and grow their government even bigger than it already is. They probably don't want to crowd out even more private sector activity than they already do. Let's put the money off somewhere else. Let's invest it and try to grow it that way. You can see how they got there. The other key thing about the Norwegian Wealth Fund, the biggest one, they have a smaller one that invests inside of Norway, but the big one, the big $1 trillion one, only invests in other countries. And the reason it does that is to avoid cronyism inside of Norway. Because obviously, if you had this much money to swing around, you could really screw up the Norwegian economy. The Norwegian economy is not that big. And if you have politically connected people in Norway who got investment from the sovereign wealth fund, that would be a huge, huge problem for them. So to prevent that from happening, they said, no investments in Norway. It's all got to be in other countries. Now, let's compare that with the United States. Remember, I said Norway has a savings rate of 8%. The United States has a savings rate of about 4%. So So it's half as high. So already we're way different. 8% and 4% might sound kind of the same. They're not that far away on the number line, but in percentage terms, 4% is half as big as 8%. So that's a big difference. The US has a debt to GDP ratio of 122%. That's about 3 times as big as Norway's. Our government debt is bigger than our total economic output, and it's growing. It's not stable. So that's a completely different spot to be in than Norway. And the US used to have a pretty healthy budget in the 1990s. Norway has had budget surpluses almost every year since the 1990s. We took a budget surplus in the 1990s and we turned it into enormous deficits here. Our government runs deficits every year now. And they get bigger for the most part every year, and they will continue to do so based on the forecasts we have for the foreseeable future. So we don't have a bunch of extra money sitting around. We already have too much debt, and we already don't save enough. That is not a situation for a sovereign wealth fund. So any kind of economic argument you want to make for a sovereign wealth fund, it just really doesn't apply to the United States. So that's why this would be a bad idea. The government shouldn't do it. Now it's time for the paper of the episode. But before that, if you've enjoyed this episode, please subscribe and leave us a positive review wherever you get your podcasts. It helps us to know that you enjoy the show, and it makes the show more visible for others to start listening as well. The paper of the episode is from the American Economic Journal and Economic Policy in November of 2021 by Youssef Benzarti and Alyssa Tazitunova of UC Santa Barbara. It's called Do Value-Added Taxes Affect International Trade Flows? Evidence from 30 Years of Reforms. So this is a paper where economists put to the test the theory that I just talked about earlier about value-added taxes. I was explaining before how value-added taxes are trade neutral, how they don't really affect trade, how they're not tariffs, and they don't provide subsidies for European companies. What these two economists from UC Santa Barbara did is they went out and they looked at the data and they said, is this actually true? This is really good economics. This is what we want economists to be doing. There's a lot of stuff that gets published in economic journals that doesn't make a lot of sense. It's not very useful. But this paper, they actually go out and they say, hey, we have this theory. Does it work? Is it really true? And so what they do, how would you test this in real life? You would look at when countries change their VAT, when they change their value-added tax, does it change their trade flow? If it does, that would indicate that the theory is wrong. Because the theory should say that the VAT should not really change trade. So they go out and they test that. They looked at every single VAT change that happened in Europe over a span of about 30 years, from the 1980s to the 2010s. They look at every single one. And then they look at the trade data and they say, did it change it? And what they find is basically no. The change is negligible. The change is barely there. Obviously, there's going to be some change that's going to happen in the real world. The real world is never going to perfectly match up with the theory. But what their paper shows, and it's pretty rigorous, they go through and they test and they make sure it's not because of other stuff and they make sure it's not because of other factors. And they find no, there's really basically no change from VAT changes that affect trade flows. So this is another good sign that this theory is actually true. And this is a really good paper that shows that. So again, it's called Do Value-Added Taxes Affect International Trade Flows? Evidence from 30 Years of Reforms by Benzarti and Tazitunova. Read it. That's all for today. Remember, the economy is complicated and nobody has all the answers, but markets work.